Hi, guys. I'm Felix Salmon of Axios, which is Greek for please subscribe to my newsletter. You can do that at Axios.com. This is Doug Lebda, the CEO of LendingTree, which, why don't you start and tell us what LendingTree is and does?
Sure. So LendingTree is a marketplace for every type of loan, also deposits and now insurance. Our clients are 500 of lenders, credit unions, online lenders, major banks. They're basically advertisers, and our customers are everybody in America. And we bring the two together. Lenders pay us fees for getting introduced to consumers. They are able to bid those up and down based on their own marketing strategies. And it's proven that it works with lenders, and we save consumers real money.
So you're basically a customer acquisition channel for lenders.
Yeah.
And once they get a customer from you, these lenders can be quite aggressive. No, I mean, they can really, this is one of the things I've heard about LendingTree is that people are like, I signed up with LendingTree and now these lenders are just like really pestering.
The origin of LendingTree was in the mortgage business, and our first customers were correspondent mortgage companies. And because the mortgage process was so complicated, we allowed lenders in that competition model to actually not only post real live offers online, but also to call the borrowers. And we are clear with that, the consumers, about half the people love it, and half the people think that drives them crazy. And we're working on a new model right now where where that'll be eliminated, where you're basically going to come in, see all of your offers in a logged-in experience. We will help you make the right choice of a lender, and then we'll transfer exclusively to one lender. In addition to that, we've got something called My LendingTree, which has about 15 million members on it. And on there, it's an exclusive match with just one lender anytime we can save you money. And that thing's growing like a weed and is really the key for our strategy going forward.
And that's like a personal finance app, right?
Yes. So basically, you come in, you sign up for My LendingTree. Obviously, we're giving you free credit reporting, free credit monitoring. But then importantly, because we're networked in with basically every lender in the country, we can continue to alert. We can see if we can save you money or improve your credit. So I'll give you a good example. The guy comes in signs up for My LendingTree, has a 600 credit score. We recommend he takes his credit cards, refinances them into a personal loan. He does that. His credit score goes up. Then he can refinance his auto loan. He refinances student loans. Now he can afford to buy a house because his credit score has gone up and we've saved him hundreds of dollars a month.
See, it's a beautiful thing. But this is what Credit Karma does, right? So who's better? This is a loaded question. I'm sure they're much better than you are, right?
They got a good jump on us in the free credit report space. We think, and so they have about 50-some million members. We think they're more concentrated in credit cards. Obviously, they're a lot bigger there than we are. However, we're a lot bigger in mortgage, home equity, auto, personal, and we're going to catch them on the member side. What we've done over the last couple of years is added members through the normal, just coming in from LendingTree for other loan products, and then we would ask you if you wanted to sign up for this too. But now that we've got such a good handle on monetization, that we've got so many products in it, we're hoping this year to do significant marketing and branding campaigns. And it'll be really centered around the alerts and saving money. We think the free credit report space is kind of crowded and undifferentiated. So we're coming at it with a new message around alerts and saving you money across your entire financial life, including deposits too. We just added deposit accounts. So now we've got a marketplace for assets too.
So I feel like I need a deposit account, and I go to LendingTree, and you tell me which deposit account to.
Yeah. So the brand it's under right now is DepositAccountscom, and it operates independently. And we also then can cross-sell that with LendingTree. It's not as integrated into LendingTree as we want, but yeah, there'll be deposits on LendingTree and deposits inside of My LendingTree. And once you sign up as a member, we'll alert you when you can get better interest rates.
And this is part of what you've been doing as, I want to talk to you a little bit about the public stock markets, because you're a public company, which is, I think, quite rare among the kind of people who are on stage here today and tomorrow. We have this huge year for tech IPOs, and as far as I can make out, we have 0 in finance. Like, is that because everyone is still like bearing scars and bruises from Lending Club and On Deck?
I don't think so. I think when you go public now, you really need to have the business model nailed, the revenue model nailed. You need to have a lot of infrastructure internally because you got to deal with Wall Street. We've gone public twice, once in 2000, and we did it because we needed money to spend on marketing. So we did a $50 million capital raise in 2000, survived the dot-com crash. In 2008, it wasn't our choice. We were part of IAC, Interactive Corp, and they decided to spin us out. On day 1, we traded to 0. So then it's not good to be a public company. If you're a micro cap, small company, not appreciated. But as now we're getting the benefits of being a public company because we're $4+ billion market cap and we're big enough and at scale and all these different products, and we've got the right infrastructure. The other thing on public versus private, though, there's so much private capital that there isn't necessarily the benefit of going public. If you need to cash out shareholders or you need to raise significant capital, the public markets are great. But there's so much private capital that there's not necessarily a reason to do it. So you just have to do it for the right reasons.
So do you think we're going to see any fintech IPOs anytime soon?
Honestly, I don't know. I think it's going to depend on the business models and on the individual companies and on their desires. And so I'm going to give that one a big fat I don't know.
Fair enough. But one thing you have been doing as a public company is a bunch of acquisitions, right? So like you start as a mortgage company, and now mortgages is what, 20% of what you do?
Yeah, mortgage is now only 18% of our business. Insurance is just exploding, and so that's doing great. We're able to do acquisitions because the LendingTree brand is known by about 80% of the US population. And so, for example, when we made our credit card acquisition in Compare Cards, all of a sudden, they had 10 years of history with the credit card companies. They had significantly higher payouts. You take their payouts plus the LendingTree brand, and now we've got a significant credit card business. Same thing in student loans. We've done that across some content categories. LendingTree has traditionally been lousy at SEO. We made a couple acquisitions and now have a content creation machine that puts high quality content out there, does a lot of research and studies, and then drives a lot of traffic for free too.
So tell me about SEO. I mean, it seems to me that to a large degree you are in, that is your business, is SEO. I mean, you have to, or at least search is your business. If you can't SEO that stuff, then you have to
you pay for it.
Pay Google. How much are you paying them? Like
Google, I think we're just in lending, we're pay about $350 million a year. But we spend, keep in mind, like, and that's why I say LendingTree has more in common sometimes with the online travel agencies than financial services. And that's because as your unit revenue goes up, you can afford to go out and spend marketing. So we know in real time how many customers our lenders want to lend to, what their pricing is, how much they can pay us, et cetera. And then we go market into that. That's sort of the Google strategy, I call it. And then we're trying to do the Amazon strategy with My LendingTree and make you a lifetime member. So we're trying to, so we've pulled off the first trick, and now we're just scaling it, and now we're working on the second one.
But on the first trick, like,
and by the way,
Google can just like keep on raising its prices on you until like they're 80% of the value of each customer, right?
So the beautiful thing, about Google is Google works very similar with us than the way we work with our lenders. So we go to lenders and help them run ad campaigns inside of LendingTree and say, I want borrowers in 10 states with this credit profile, and they'll set up hundreds and thousands of individual filters, just like we set up keyword campaigns in Google. And as we've gotten better at converting into Google, we've obviously been able to up our bid substantially, but because the LendingTree brand's well known, we can actually underbid in Google and still maintain very good positioning. So we'll advertise wherever we can to make money, and TV, the good thing about us is TV works for us because the brand's well known. And that's and the other nice thing for a lender standpoint, because we're not completely dependent on SEO, a lender can come to us tomorrow and say, hey, what would it cost me to get 50% more volume? And we can actually give them a number. Whereas if you're just dependent on your own traffic, you can't go market into that bigger request that the lender has.
So you, as a two-sided market, you have kind of two different loyalties here. You have an advertiser, a lender coming to you and saying, you need to get me a whole bunch of customers, and you're like, great, come in, here, put your ads all over my site.
Well,
you know,
it's not an ad, it's an offer.
Offer all over my site. You know, on the other hand, if you're pushing that lender to me as a customer, on some level, you're not being entirely objective about who I should.
Oh, no. We are, the offers that the consumer gets are highly competitive on both price and service. So every one of our lenders has ratings and reviews that matter almost as much as price. And then we're going to present you with the 5 best deals. What we find is that lenders, is that we only present you 5 because we don't want to overwhelm you with choice, but then the borrower makes the decision. And a lot of times, they'll get our offers and then take it down to their local bank and use that as a shopping mechanism. But yeah, we have, so for example, in personal loans, the average difference between the low price and the high price is 500 basis points. We can save consumers real money by comparison shopping, it's proven. On the lender side, because the lenders can profile, just like we do in Google, the exact types of customers where they can be the most competitive, that competitive aspect helps the consumer save money. And then what we have to do is make sure that the lenders can still have margin, and that typically comes through improvements in conversion rates. So what we're seeing now, like that's why we're all in this room, is significant progress on electronic mortgages, significant progress on automated decisioning, automated underwriting, and you're also seeing this explosion in different underwriting models. So SoFi does it different than Marcus, et cetera, and that, because you can give the consumer transparency around the entire marketplace, they can save money, and it works for lenders too.
So you have a kind of unique insight into what various different types of lenders are asking for, how much demand they have, what their pricing is. Anecdotally, banks seem to be tightening up their consumer lending underwriting, maybe their pricing a bit. Have you been seeing that? And is that because they're seeing default rates rise?
I hear the same thing I can tell you what I can see in our market. We've seen, for example, in personal loans, but this is natural, by the way, that lenders started with a wider box, and the box went away for a while. And now I think it's getting appropriate as lenders are dialing in.
So you're saying it's
so yeah,
the range of people they're lending to is shrinking.
The types of customers they're requesting is shrinking, I believe, because of a slightly tighter credit box, but it's not a lot. And then what you're going to have happen is you're going to have specialists. What typically happens I'll give you an example in mortgage. Day one in mortgage, lenders want everything. Well, over time, you're a jumbo lender, you're a subprime lender, you're a specialist in a certain area. And I think what we're going to see in personal loans and in credit cards is you're going to see the return of the specialist. So you have subprime, so you might have the major credit card issuers cutting back their credit box, but then you still have subprime credit card issuers who will fill that in.
But the reason they are doing that is because they are seeing an uptick in default rates on the lower credit customers?
I think it's more about, it may be, but it's also, and keep in mind in the online space, because we're so early in the penetration, that lenders, that you can actually grow through a tightening credit box. Only probably 5 or 10% of personal loans are done online today. So as lenders, they still want a lot of volume, it's just in a tighter box. And I think it's more of, I don't know, I don't have insight into default rates, but I can tell you where lenders are marketing.
How about student loans? What's the trend there?
Student loan refi, the trend is we got to keep telling people about it because people think you cannot refinance your student loans. We have a business called Student Loan Hero, which writes a lot of content in that space. And that business is going to continue to get better and is going to continue to get bigger and bigger because there's a lot of consumer benefit in refinancing student loans.
But only on prices, right? I mean, like, I feel like this is one of the areas, again, where you're not being fully honest about, like, the downside of refinancing, or, you know, federal loans into a private loan. Like, you lose a bunch of, you know, ability to write them off after 10 years and stuff.
No, listen, you need to, if you're not going to repay your loans, you're right. You could then leave it in one where it's going to not, but if you're planning on paying back your loans, which most people are, obviously student loan default rates could be a worry because of the rising cost of education, and I hope somebody fixes that in the educational system. But we think that is an early market right now.
And that
it's small for us. It's in
because I mean I feel like SoFi, you know, obviously that was where SoFi got big in the first place, and I kind of, again, anecdotally feel like they feel like they might have got, you know, that's not growing as fast as it should be for them, and that's why they're branching out into so many other products.
Yeah, and well, first off, if you're a multi-product company, is always better than a single product company. So I always break business models in financial services down into 3 categories. You can either acquire customers, and you will get money for helping people acquire and market. You can take risk in our business, lending or issuing an insurance policy. And then in the middle, you have obviously technology, processing, automation, et cetera, et cetera, et cetera.
And you were telling me earlier.
So SoFi, for example, once you get a customer, if you can add on other products, that's going to do that will, which we see, right? So the more products we have, the more our unit economics go up, the more we can market it. So personal loans is a great example. Years ago, before we relaunched personal loans, we had like 3 lenders with lousy service and not great pricing, and you had to close in a branch. Well, now there's like 60 of them, and so the demand from our lenders is probably 20 times higher than it was then, and the average revenue is 15 times higher than it was before. And so now we can market that online and also in TV. But then a lot of those people are coming in for that. They might say, oh, personal loan's not for me, but gee, I can refinance my mortgage. And so you can pick up more products. So I think that makes a lot of sense. Now, so the more products you have, I think, the better for online companies. And the thing that I like, SoFi is a good example of it, is the explosion in different ways that you underwrite loans. And so I love that SoFi does it differently than Bank of America, who does it differently than somebody else, because that's what makes the marketplace work.
See, that's the second time you said that, and I'm fascinated by this, because I feel like that was what, you know, these kind of conferences were very much into 6 or 7 years ago. Everyone came out like, we have a magical new underwriting black box, and I have been hearing that a bit less of late. You really do think that there's significant difference in the underwriting algorithms between your different clients?
I think, well, SoFi is different because they're doing it based on different criteria, but the good news, listen, the challenge for if you're a lender, right, is that over time, margins can tighten because there's more competition. That's just natural. And so SoFi's got a great model, got a good lead on that, but there's no reason that another company can't do something similar. And you see, just like we had in personal loans, there were lots of copycat platforms that came out. They can all do very well on their own, but LendingTree benefits by having 60 of them because we've got much more coverage. It's the same theory as Google's long tail. The more advertisers you have and the higher the conversion rates, the better off you are. The biggest thing, though, the cool thing that we're starting to see is the more technology enables online transactions, the better off, first off, everybody does. It's better for the consumer. But with LendingTree, that improves a lender's conversion rates. And as they convert better, they're willing to up bids. So if you were converting 1 out of 10 customers, now if you're converting now 1 out of 5, you theoretically would up a bid to get more volume, to maintain that same cost per funded loan.
I wanted to ask you, we just had one of the CFTC commissioners come out and start talking about the risks of climate change to the financial industry in general, and specifically to the insurance industry. This is, again, one of your you know, areas which you suddenly seem to have become big in is insurance. Like, have you any thoughts on that?
I think it's a real risk. I'm not a denier in any fashion, and obviously, if homes are getting flooded, it's not helping values, and if they're getting blown down in hurricanes and tornadoes, it doesn't help values. Older homes would obviously be hurt more in coastal cities, so it's a real threat. Now, I'm assuming that the insurers can price that risk in, but it's going to get more expensive for consumers.
Let's do a quick lightning, overrated, underrated round. You didn't want me to say this. You're like, no, just ask me what I think, but we're going to try and get some actual opinions out of you.
All right. This is hard because I've got a lot of clients. I told them that. I'm like, I can't be, I got to be somewhat politically correct.
So I'm going to start with Square. You were a little bit bearish on payments when we were talking earlier. You said it was becoming commoditized, but that seems to be the only public company, only public fintech company which is doing well these days. What do you think about payments in general and Square in particular?
So payments in general, Square, I think, is a great company and is doing a lot of innovation and has a huge user base. So they've overcome the customer acquisition problem, and that's key for any fintech business. You have to get to a level of scale where you can actually make money. Payments in general, I think, is very open to, there'll be 50 payments companies. And I think the ones that are going to win are the ones that are attached to, like you asked me about, Ali, are attached to a huge customer base. Facebook, Alibaba. And I think Square has that opportunity too.
So what do you think about Facebook's move into crypto with Facebook Coin?
I think crypto in general is one of those things that just got a little overblown. And you don't need 50,000 different coins. It's interesting that Facebook took that approach as opposed to doing payment facilitation. And by the way, like, you know, so look at Apple, right? Apple sits in a perfect position because it's on your phone. And they've got an installed user base, so it's easy for them to add on something else. And I think it's Facebook. I would never count Facebook out because they know everything about you.
It's true. Credit unions.
Underrated.
Underrated?
Underrated. They need to come online faster. I haven't met a single person who's in a credit union who thinks their credit union's bad.
Marcus.
I think they're going to be very, very good. You see them being very diligent, very deliberate, and I think they've got a huge opportunity in the bank space to be a real winner.
Bernie Sanders.
Completely overrated. Socialism doesn't work. And if he got in office, God forbid everybody in this room, because the regulations will come in fast and furious with all kinds of stupid things like capping interest rates and all kinds. I always say, like, whenever you want to try to have the look at credit cards. When all the credit card regulations came out and they had to cut fees, et cetera, what did it do? They cut back on their subprime borrowers. And now, what do? If you can't get a credit card, now you got to go to Joey Bag of Donuts, and you can't just default on your credit card. You're going to get your kneecaps knocked off. Or you got to go to a check cashing store. So I would rather have an open and fair market where the credit market for consumers is like the debt market for companies. You've got a score, you've got a rating, lenders look at you, and your rating is based on you.
So payday lenders, they're fine too?
Yes.
Okay.
Listen, it's not, if the consumer's gonna get it, you'd rather have it in an open marketplace where competition is going to force appropriate pricing over time rather than saying, just shutting off the credit. Now, you gotta be careful with your credit score, obviously. That's why credit improvement is such a big thing.
I'm trying to find a demonized financial company that you don't like. Wells Fargo.
Well, given they are the second largest bank in my hometown, they have to overcome a whole bunch of consumer trust challenges, but at the same time, people that I talk to there seem very committed to it, I think they got a shot. Again, they got a big user base. So if you've got a big user base, I always say that most banks never want to be first, but they all want to like tie for second. And so I think you're going to see banks moving more and more online, and they've got a shot.
Doug Lebda loves everyone in finance. Thank you very much.
Thank you.
Cheers.